All right. Today is Thursday, September 1st, a new fresh start, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight, and let's start by this. Early on in the morning, the market was getting dumped hard and fast, as if it was Leo DiCaprio's girlfriend after turning 25. Speaking of, unfortunately for the ladies, DiCaprio is no longer single. He found somebody new, just like that. She's 22, Russian, tall, long legs, no problems here. But those 3 years, they make a lot of difference. To Leo, at least. But the good news is, the relationship has about 3 years before expiration date. So if you happen to be 21 right now, you still got a shot in 3 years or so. And then when you become 25, the cycle gets reset again, and somebody who was 18 takes your place. And then the cycle gets reset again, and somebody who's 13 gets, whoops. Let's just hope and pray that Leo DiCaprio in his older age not going to become a creepy cult leader surrounded by inappropriate age girls, like somebody we know. But anyhow, after the market got dumped, just like we talked in yesterday's video, we have a long holiday weekend coming, Labor Day, and then we have a shortened trading week next week. The odds say we're going to see short covering ahead of the long holiday and the shortened trading week next week. And this is exactly what we got today by the end of the day. During the last 2 hours, we started to see short covering arriving and the market closed at the highs of the day. And my strategy, as I've told you in last night's video, is to sell out of the money puts with shorter expiration dates on contracts that I already have. And these contracts happen to have longer expiration dates later on in September or even October. I also opened a call spread. I'm not sure it's going to work or not, but I bought Tuesday's Triple Q's 300 call and I paid around $1.40 a piece for entering those. And then as the short covering was intensifying, later on in the day, I sold the 300 calls with tomorrow's expiration for $1.40 a piece. All in all, my entry cost is $0. I don't care how the trade is going to go, but if the Qs closes below 300 and then on Tuesday next week we see the Qs above 300, this trade will score big. And I mean big. And by the way, I'm not the only one who says that we're due for a bounce. Even among the bear community, for example, the Northman, he also sees a reverse head and shoulder in the NYSE. And this guy known as the chart master on CNBC, he also sees a bounce coming. So this is the assumption for now. But we have a wild card coming, and that wild card is the employment report in the morning tomorrow, or by the time you're listening to this program today. So do me a favor and watch last night's video because we talked about the jobs market in details. A lot of you missed out on watching that video because it came out a little too late in the evening, but it is a good video and has a lot of information. Now, we have a teaser that we got today. The jobless claims were actually lower than expectations. We got 232 claims, so it appears that the jobs market is still hot. And the bulls, of course, are hoping for either a soft landing, although they appear to be abandoning that as of late. So what they're hoping for is that the Fed will see the damage in the jobs market and they will back off in September in terms of increasing interest rates by 75 basis points. The bulls are hoping that the Fed will settle for 50 basis points, or better yet, 25 basis points. Now, here's the problem for the bulls. Number one, if the jobs number comes out hot in the morning tomorrow, that means perhaps the Fed needs to do more and become even more aggressive. But I have a feeling that the bulls want their cake and eat it too. If the jobs number come out too hot, they're going to go back to their soft landing play and the Fed is going to pivot. They will say the jobs market is doing pretty good, but inflation is moving down. Here's the problem. The Fed is not just watching commodities, folks. The Fed is watching unit labor cost. And today we got unit labor cost, and guess what? That increased by 9.3% year over year, the highest levels since the first quarter of 1982. And to me, this is problematic, at least for the bulls. Because even if the jobs number come out too soft, now we're talking about stagflation. The jobs market is weakening, but unit labor cost is still too high. See, the bulls lose either way. But here's my hunch. I think the seasonality will be supreme. What does that mean? We're going to see more of what we got today, meaning an attempt of dip buying again. The problem is the wild card, the jobs report. Is the dip buying going to happen from the same level of closing today? Is it going to happen from a gap higher in the morning? Or is it going to happen from a gap down in the morning? This is how the jobs report factor in. But I believe that Labor Day weekend will push a lot of shorts to cover and book profits. So dip buying will happen either way. That's my take right now, but we'll see what happens tomorrow. In this episode, I'm also going to talk about Jeremy Grantham. He has a major call major bearish call. And a lot of YouTubers covered that, Jeremy Grantham, the end is here. And they get a lot of clicks, but all they do is just read what Jeremy Grantham said. But they're not putting in an analysis of what that actually means. So I'm going to do that for you in this program tonight. Now, before we move on, we're getting closer here in this channel, folks, to getting 100K subscribers. We're short about 100. About 30% of you who watch this program are not subscribers. I mean, how hard is it to move your fingers and click the subscribe button? So do me a favor and let's get to the threshold already. And while you're at it, next to the subscribe button, you got the join button to become a Maverick member and support this channel. And if you don't see the join button, you're going to see a link in the description and the comments that will lead you to join. And if you don't want to do that, you want to subscribe one time only, you got the thanks button. You can leave a tip right there. And I know what you're going to say, Maverick, you're charging too much. That's a lot. Really? You're the same guy who's paying $50 a month on OnlyFans, right? And it's not only one chick. It is multiple. So you're paying $50 a month for I don't know how many women on OnlyFans. For what? To get pictures of dirty feet so you can jerk off to that? The process takes from start to finish about what? 3 minutes tops? Meanwhile, your uncle, the Maverick of Wall Street, is giving you almost an hour every single day, 5 videos a week for $10 a month. That's 50 cents per video. And the beauty of all of that is I teach you how to fish in the stock market so I can put money back in your pocket. You give me 10, I give you 100. You give me 100, I give you 1,000. But anyhow, we got a lot to talk about here, folks. Let's move on. And here it is, in focus tonight. The grand finale, a dire warning by legendary investor Jeremy Grantham. But before we talk about that, here's a look back on what Jeremy Grantham said in his prediction of the market crash back in January of last year. Take a look.
If you're looking for the very early warning signs of a bubble breaking, you find the stocks that have done the best, SPACs and particular SPACs and Tesla and Bitcoin, and you wait until they start to have these big daily drops, and then they recover and they drop and they recover, and that's the very early warning. And the market in 2000, for example, didn't go together. They took out the pet.coms and shot them. The rest of the market continued to go up. It didn't even deign to notice the shooting of those little guys. They were only worth scores of millions or a couple of $100 million. Then they took out the junior growth stocks and shot them, and the market kept going up. And then they took the medium growth stocks and shot them. And finally, by the summer, they were shooting the Ciscos. And the entire tech part of the market had been shot. And that had been 30% at the market peak of the total market cap. And yet, the S&P by September was at the co-equal high of March, which meant that the other 70 had continued to rise. So that is a typical way. Bubbles don't necessarily break en masse, but having sliced off the tech and the dot-coms, then finally the 70%, like a giant iceberg, rolled over en masse, the 70%, and went down for 2.5 years by 50%.
So in essence, what Mr. Grantham said is the crash happens in increments. It doesn't happen in one shot. These are momentary crashes, and the stock market recovers right away after that. We've seen that during 2020, the Thing crash back in 1987, etc., etc. But a legitimate crash, an end of a cycle kind of crash, a beginning of a bear market kind of crash, happens in increments. First, the hypermania names, the small caps kind of names, crash first. The SPACs, the meme stocks, etc., etc. Then the medium caps, the reopening names that went way too high too fast. And then come different cyclical sectors of the market, such as chips. They crash after that. A little by little, big tech crashes. And the last blocks are usually the top names. And I told you it's going to be Apple and Tesla. These will be the last blocks to fall. Why? Because Apple is a pulse of the institutional sentiment in the market. Once the institutions lose faith in Apple, that's when the grand finale happens. Likewise, Tesla, the souffle, is a pulse of the retail sentiment in the market, the retail investor. We're not talking about apes. We're not talking about these temporary participant in the stock market. We're talking about retail investors, mom and pop, who've been investing in Tesla for years. Once they capitulate and start dumping Tesla, then we see the mother of all shorts and the mother of all crashes. The last two blocks, usually Apple, Tesla, and I'm going to add Berkshire Hathaway. We'll talk about that in a second, but let's hear what Jeremy Grantham said in details. He said, prepare for an epic finale, and he warned that there is a tragedy when this super bubble bursts. It's already bursting right before our eyes. A super bubble, quote-unquote, appears dangerously near its final act, quote-unquote, after the recent rally in U.S. stocks lured some investors back into the market, just ahead of a potential tragedy, according to Jeremy Grantham, the legendary co-founder of Boston-based investment firm GMO. Mr. Grantham said that economic data inevitably lags major turning points in the economy. He also added, to make matters worse, at the turn of events like 2000 and 2007, data series like corporate profits and employment can subsequently be massively revised downwards, you paying attention or not. Grantham also said it is during that lag, or this lag, that the bear market rally typically occurs. And now the current super bubble appears to have paused between the third and final act. According to Grantham, prepare for an epic finale, he said. If history repeats, the play will once again be a tragedy. We must hope, this time for a minor one. Hope is not a strategy. Tragedy will strike. No doubt about it. Now, when Grantham talks about the final act and the epic finale, what is he talking about? He's talking about similar instances that happened before in the stock market. During the crash of 1929, the Great Depression, the early 70s, the dot-com collapse in the year 2000, and of course, the great financial crisis back in 2008-2009. What Grantham is talking about is he's actually channeling his inner junior soprano, and he's saying things come in threes. What does that mean? The bear market has 3 bounces, usually, not always. But I'm going to show you examples, and it's really creepy. It has 3 bounces. Bounce number 1, the complacency stage. Bounce number 2, the anxiety stage. Bounce number 3 is the denial stage, in which market participants say my investment are in great companies. They will come back. And perhaps this is what we saw in the so-called summer rally, the so-called June bottom. But then what happens? The answer is the epic finale, which is the panic stage. When everybody panics and says, you know what, everybody's dumping, I gotta get out. When that capitulation happens, we get the grand finale, the massive crash that you will live to tell your grandkids about. And then comes the bottom. In other words, Mr. Grantham is predicting a massive, historic crash.
Some men just want to watch the world burn.
You like that, Michael Caine? Some men just want to watch the world burn. Anyhow, if you look back in history, this is what happened before. And it is absolutely creepy. Look at this. This is the crash of 1974. You got a trend line. The bullish trend is broken. The bull market ends. And then we have 3 major bear market rallies. After the third one is done, we see the epic finale. The one big flush that everybody talks about for years to come. So this is the 1974 example. What about the dot-com example in 1999-2000? Here it is. The trend line was broken. We got 3 major bear market rallies. After the third was done, we got the great finale, the massive flush down. And then came the bottom, and the stock market stagnated in a bear market for years before creating another bubble. And that bubble is the housing bubble back in 2007 all the way to 2009, the great financial crisis. And look at this. This is the chart of the SPX, by the way, the S&P 500 weekly chart. Trend line broken. The bull market is over now. We get 3 major bear market rallies. After that, we get the grand finale, the massive crash all the way to the downside. Now, let's fast forward to what we have right now in 2022. There was a trend line that was broken. Same chart, SPX, cash index for the S&P 500 weekly chart. Once the break happened, so far we got 3 major bear market rallies. And what Jeremy Grantham is saying is, we're done with the third act. Now comes the grand finale. Just like we saw back in 74, just like we saw back in 2000, just like we saw back in 2009, and just like we're about to see in 2022 or maybe 2023, but we're getting close to the grand finale. Now, to be fair, this is Grantham prediction, but the bulls will counter and say not so fast, because what if what we're seeing right now in the S&P 500 is a reverse head and shoulder pattern? So the battle continues to go on, but if the bulls lose the hope of this reverse head and shoulder pattern, and we start to see 3,800 being broken, oh boy, the epic grand finale is coming. Now, when we talk about the epic grand finale, is that crash going to be led by names like Zoom, for example, or Roblox, or any of these names that are already crashed? The answer is, yeah, they're going to go down a little more, but they've already crashed. This grand finale will happen when the last blocks crash. What are we talking about? We're talking about Apple, we're talking about Berkshire Hathaway, or we're talking about Tesla. So if the grand finale happens, this is a monthly chart of Apple. We have a massive reversal candle for August. If that holds on, we will see more downside, and Apple could crash all the way down in the Grantham scenario by over 48% from this point on. Likewise, In the Grantham scenario, Berkshire Hathaway, this is a weekly chart, already formed a head and shoulder, not reverse, but an actual head and shoulder. And it is crashing down. And it formed a bear flag. That bear flag is already playing out. In the Grantham scenario, we will see Berkshire Hathaway moving down from this point on by at least 19%. What about Tesla, the big one? This is a monthly chart. In the Grantham scenario, we will see another head and shoulder formation, and Tesla from this point on could crash all the way down by more than 60%. This is if the Grantham call, the grand finale happens. Once again, we got 74, 2000, 2009, at least 3 cases that tells us the same will happen again. And the next step is the grand finale, the panic stage of the crash. This is what history says. Now, is there room for a miracle? The answer is yes. But a lot of things have to go right for the bulls to evade the epic grand finale act. And we're talking miracles here, not just the Fed pivoting, because the economic cycle is out of control of the Fed. If a recession happens, and it is a deep recession, it doesn't matter if the Fed cuts interest rates by what, 2.5%? To 0, that's not going to save the stock market and the economy. So the odds right now say Grantham is likely to be correct. And if he is, oh boy, you're going to be looking at the charts on your screen like that kid from The Shining, and Papa Jerome will knock the door and say, "Here comes Jerome," with 100 basis points. Again, a dire prediction, but we've seen it before repeatedly. And folks, let's be honest here. Look at the monthly chart of the SPX, the cash index for the S&P 500. We have a trend line that goes all the way back since 2009, the bottom in 2009. And that trend line has been tested repeatedly. Usually in crashes, we get the market from top to bottom going down by about 50%. Now, if we go down top to bottom to the trend line, and let's say the epic finale takes place in February of next year, that will be a crash top to bottom of about 36%. I would say that's mild when you compare it to 2009, 2000, or even 74. But do we really believe that the chart will never retest this trend line again? I don't think so. I think we're destined. It is inevitable for the chart to go down and retest this trend line. And again, if it does, it could be an epic finale, but it's really not out of the norm. Now, you might say, what if the epic finale will pierce below the trend line? Well, that happened before in 2020, but the Fed came to the rescue. Now, the Fed cannot come to the rescue because we have inflation. So yes, it could get a lot worse. And maybe this is what Mr. Grantham is calling for, that the trend line will be broken. We will see a massive epic finale. We'll see what happens, folks, but for now, the odds say Grantham will be right again. Now, let's move on and cover the stock market information, and we start with the closing of the indices today. And here we go. The Dow Industrial Average up by 145.99 points, or a gain of 0.46%. The Nasdaq closing in the red, but way off the lows. They closed negative by 31.08 points, or a loss of 0.26%. The S&P 500 positive by 11.85 points, or a gain of 0.30%. The sector's performances were led by healthcare, number 1, capturing the gold medal. At number 2 for the silver, utilities. Number 3 for the bronze, communication services. On the other hand, the laggards of the day led by materials, energy, and technology. What about the advance to decline ratios? NYSE 30% advancing versus 68% declining. The Nasdaq 32% advancing versus 65% declining. What about commodities? Now, I was a little late in taking the screenshot from Finvits, but it was a down day all in all for energy, for metals, for grains. So this is what I'm going to do. I'm going to do something different here. Number 1, let's talk about some energy news. And we got a shocking piece here overnight from Lukoil from Russia. And apparently the chairman of the company was staying in a hospital and he jumped out of a window. And when Vladimir Putin was asked about what happened to the guy, he said he just wanted to get fresh air. And speaking of Russia, you know, one of the tailwinds or headwinds, depending on how you look at it and how it's going to end up being, the price cap on Russian oil, led by the genius, Janet Yellen, transitory Yellen, it doesn't appear to be working. And in my opinion, I thought the price cap will backfire and it will actually lead to higher oil prices, because the moment the genius Yellen places the price cap on Russian oil, the Russian will cut their supplies perhaps entirely from the market, and they will cause prices to move higher, and then they will sell in the black market to China and India and make profit that way and punish Europe and the West even further. Now, Janet Yellen believes that the Russians will just obey whatever she says and they will just say, okay, we'll go along with that. we're going to sell our oil at a loss, missing out on the gains. No problems here. We're just going to obey whatever you say. It's delusional, but the fact that the price cap now is falling apart and oil prices are going down, that tells you that my thinking is right. That the oil cap, if it ever happens, it will actually backfire and push crude prices higher again. Now, the second thing I want to do in the commodities segment is to cover certain charts. We're going to start with natural gas. Let's do that. Here's a weekly chart for the Henry Hub. And as you can see, we have a bullish channel. We are pretty much at the top of the channel. We also have negative divergence on the RSI, which means the odds say we could see a drop down in natural gas. But we know the tailwinds are really strong. So for the bulls to win, they have to crack above the channel and close the week above that channel, not just by a little bit, but by a lot. So we can say, okay, we have another impulsive rally here, a higher high coming from natural gas. And then we have cotton. This is a weekly chart for cotton. The bullish trend is over, massive crash, but we also have a massive rebound. Yet recently, this week so far, cotton went down to close the gap. Now here comes the question. Are the bulls going to win? We see cotton futures rebounding higher after closing the gap. This take is supported technically by the MACD. Look at the MACD indicator. We have an imminent crossing coming. If that is the case, we will see cotton prices shooting up higher again. But if the bears are right, the bears would argue and say, maybe this is a formation of an ABC pattern. The recent rebound that we got is the B leg, and soon enough we will see the C leg forming out, and that will take us all the way down to the 70s range. So watch all of these levels, and you're going to trade them accordingly. Then what about copper? This is a weekly chart of copper. The trend was broken. We have a massive flush down. It appears as if this is a bear flag playing out. Another way you can look at it is an ABC pattern, but the bulls would argue, yes, it is a bear flag formation, but look at the MACD indicator. We have an imminent crossing coming, creating new bullish momentum. And the trick here is if we have a higher low. If we have a higher low, then the ABC pattern is not going to happen. The bear flag is not going to happen. We will see copper moving higher again. So watch out for these scenarios. And lastly, let's talk about wheat. Here's a weekly chart for wheat. We have a trend line. We got the pop, the Ukraine invasion, and then the aftermath, the dump right away. Back to the trend line. Now, the bulls would argue and say the bearish momentum is topping. Look at the MACD indicator. We're about to create new bullish momentum, which means wheat should move higher. Here's the problem. The monthly charts don't look so good. And if the trend line is broken, say goodbye to any bullish outlook for wheat. Down we go. So watch for these scenarios. Moving on to the options market, the big casino. What's going on here? The volume is coming back. Perhaps options traders are playing the seasonality, not only of September, which everybody says, oh, it's going to be a bad month, bad month, bad month. I think you might see the first week and a half of September being actually good for the market. And then comes the slaughter after that. We will also have the seasonality of Labor Day weekend. Lighter volume, the shorts want to cover, the bias becomes to the upside. So we're seeing the options market gamblers coming back, buying some calls. We're seeing the ratio improving a little bit, but most importantly, the volume improved today. At number one, the hottest table by far was Apple at around 1.5 million contracts. About 50% of those were calls, so we have 50-50. That could improve tomorrow in favor of calls if we see more short covering. Nvidia at number two. Nvidia was down big early on in the morning. About 1.5 million contracts traded for the name today. About 46% of those were calls. And at number three, the Souffle, with around 1 million contracts traded today. About 53% of those were calls. And before we move on, look, options are an important mover for the market, specifically under low volume. Why? Look at what happened during the summer rally, when we have a stampede by shorts, by retail, by institutionals, by quant funds, in buying out-of-the-money call options. The dealer, in this case, who's selling you all of these contracts, the call options, they have to hedge. So they buy the underlying stocks for these call options. And we get the bounce. But then what happens after these options expire? No more gamma squeeze. And this is exactly what happened when we saw the market moving down. Similar story with the VIX. As market participants stampede to buy out-of-the-money call options and they abandon buying puts, we see the VIX getting crushed. And then what happens when these options expire? The dealer starts buying put options and they start dumping these stocks that they bought as a hedge for the call options. And they make the majority of these call option holders hold the bag, and they benefit and profit from the put options they bought. The dealer, that is. I hope that's clear. So when we see another rebound, perhaps this week, the week after that, watch out for the options market, because the data from the options market tells us exactly whether this is going to be a legitimate bottom, a legitimate rebound, or another bear market rally. On to the unusual activities that took place in the options market today. We start with the ticker IWM, and this is a big one. The Russell 2000 was the laggard, the weak card today, and somebody is betting for more pain to come. They bought the 172 puts for the expiration date October 21st with expectations the IWM could go down and lose more than 5% of its value by then. They paid around $4.20 a piece to enter this trade, all in all spending around $17 million. What about the ticker OVV, Aventiv? Somebody's betting for more downside for this name. They bought the 45 puts for the expiration date, October 21st, with expectations that the name could move down and lose more than 12% of its value by then. They paid around $2.35 a piece to enter this trade, all in all spending around $5 million. What about the triple Qs? Somebody's betting for more downside to come. They bought the 264 puts for the expiration date, September 30th, with expectations that the name could move down and lose more than 12% of its value by then. They paid around $1.85 a piece to enter this trade, all in all spending around $1.7 million. And lastly, at the bottom of the table, what about the ticker ARKKKKKK for Tesla witch Cathie Wood, who's, by the way, if Grantham is right, she's going to go kaputs, gone. And somebody's betting that that's going to happen sooner than later, and they bought the 36 puts for the expiration date, September 23rd, with expectations that the ARKKKKK could move down and lose more than 14% of its value by then. They paid around 70 cents a piece to enter this trade, all in all spending around $420,000. Moving on to the heat map analysis, what's going on here? We got the rebound, and the rebound was led by what? Was it led by commodities, the inflationary trade? Of course not. Oil was down big, so was materials. Was the rebound led by technology? Maybe the big caps, Amazon, Google, Apple, get a mini boost, but the most important sector of technology, chips, was down big, so that's not it. The rebound was led by healthcare, the big pharma names, along with utilities and consumer staples. What does that mean? Defensive theme, bargain hunting, value hunting. Could that last tomorrow? Could it change? It could change depending on the jobs number. We could see a flock back to big cap technology, to chips, to risk on altogether. Bitcoin might get a pop, or if we have a really bad reading, and bad reading is subjective, too low, too high, I don't really care. I think the market will do whatever it wants to do. But we could see a flush down. That's possible. But is it probable and likely when we're heading into Labor Day holiday weekend with an upcoming shortened trading week? Not really, but it's possible. It happened before. So we're not going to make a big deal out of the action that we got today. The theme, it is what it is for the day, but it could change tomorrow. So we're going to move on to corporate news. We start with Starbucks. Starbucks has a new CEO. Schultz is gone. He failed again. Look, the chart doesn't look good. It's actually a stone cold short. We'll talk about Starbucks maybe in the weekend. And then we have GameStop. Hollywood is making a GameStop meme stock movie. And of course, the Wall Street bets, the memers, the to the moon hoodlers, hodlers, the bros, they're actually celebrating this. Hey, geniuses, the title of the movie is Dumb Money. And then we have Tesla, the souffle. We have more bad news. In this case, the headline reads, a Tesla owner is suing the electric vehicle maker alleging his Model 3 stops for random obstacles in frightening and dangerous nightmare, quote unquote. But of course, the Tesla culties will defend Elon once again. They're going to go on Twitter and say, thanks, Reverend Elon, for helping me kill the neighbor's dog. I didn't like him to begin with. Moving on to the heat map for the ETFs. What's working here? Utilities, the value, XLU, XLP, consumer staples. Another value sector is the XLV, healthcare, the XBI up big. We talked about the XBI and the triple bottom. Even in the Grantham scenario, can the XBI go and violate the triple bottom? I don't know. Could happen, but doubt it. Yet we have weakness across the board for energy, commodities, with exception of natural gas, which was flat for the day, but gold was down big. Gold miners getting crushed. The dollar was up by more than 1% at some point in the day, and that added a lot of pressure on commodities. International markets down across the board, but India remains the outperformer so far. Now, let's move on to charts, and we start with S&P 500, 30 minutes chart. What's going on here? The chart gapped down all the way to the support we were eyeing at around 391. It did consolidate for a little while, but unlike yesterday, the buyers did show up, and by buyers, by the way, we don't mean legitimate buyers. We mean it could be the shorts, short covering, taking profits. The bottom line is the chart closed the gap, and it closed the day above the gap. Is this bullish or bearish? Technically speaking, It is bullish, no doubt about it at all. But we have a wild card, and this wild card is the jobs employment report. Once again, my hunch is we will see dip buying. The question is, will the jobs report create the dip buying from the same point at the closing today, or after a gap higher in the morning, or after a gap down? Let's say the employment report is bad. I don't care what the number is. The market perceives it as bad. We see the SPY going down to 393, even 391. Now, if that holds, we will see more dip buying, and you will see the SPY closing at the highs of the day again. And this is not because they believe that the market should go higher, but because we have a long holiday and we have a shortened trading week coming up next week. What about the daily chart for the continuous contract for the SPY, the S&P 500? Look at this. It rebounded from the trend line, and it is now above the important support, now resistance at around 3,960. Can we see a rally tomorrow and throughout next week? Even if we go all the way back to 4,100, the bears are still in charge. Once the chart climbs 4,100 and closes above that for the week, then the bulls will be back in charge. But don't underestimate these seasonalities and low volume weeks. The bulls can take advantage of these by buying a lot of call options out of the money, creating mini gamma squeezes, and we see massive pops. And then, like we saw before, people get sucked in, believing that this is it, the bottom is here, and then what do you know, the bear market resumes again. We're not going to have clarity until after Powell. And Powell is not going to talk until, mid-September? So I expect more consolidation within range until then. It's not necessarily until Powell, but until the CPI comes out. The CPI is really important because Powell will make his decisions based on the CPI. The Q's 30-minute chart, what's going on here? Closed the gap, 294.33. The buyers did show up today, but unlike the SPY, the Q's did not close above the gap. Now, are we going to make a big deal out of this? Not really. My hunch is we will see dip buying once again tomorrow. The question is it going to happen from a gap above, same level, or a gap below? So long as 294.33 is intact as support, the bulls can breathe a sigh of relief. So long as we have a closing from a weekly basis above this number, the bulls can say, okay, maybe the pain is coming to an end, at least momentarily. Now, when we zoom in to a 5-minute chart, look at the behavior of this chart today. It attempted over and over and over and over again to reclimb 294.33 and claim it as support. And it finally did that at around 10 o'clock Pacific time. And then what happens after that? The chart pulled back, it retested 294.33, and then it bounced higher. And that was the moment when I fired up the tweet and I told you that we're seeing short covering here. The retest is successful, and that will produce more short covering. And indeed, that happened, and we closed at the highs of the day. The behavior of the chart is really important. Moving on to the daily chart for the continuous contract for the Qs, it pierced below the important support of around 12,207. This is a critical support. The bulls must not lose this support. So they fought hard. Maybe the shorts helped them out. It doesn't matter to me. But at the end of the day, the chart closed above 12,207, forming a really positive bullish candle. Yes, we have negative divergence on the RSI and the MACD. That means in the long run, we could go down again. But in the short run, the technicals are supporting a bounce tomorrow. Can the jobs report change all of that and we see a flush down? Possible. But the technicals say if the jobs report is not really disappointing, we should see more of what we saw today. But here's the problem. Perhaps the warning signal. The 30-minute chart for the IWM, the Russell 2000, the laggard for the day, the outlier. S&P closed positive, the Dow Jones closed positive, the Nasdaq almost positive, not the IWM. The IWM was down big. Yes, it caught some support from around 178.60. However, it did not close the gap and it did not reclaim the important resistance or support now resistance at around 183.25. That can happen tomorrow. Maybe the IWM is a lagging indicator, not a leading one as most technicians believe. I don't know. We'll see. What about the Dixie, a dollar chart? A daily chart. We got the massive pop, over 1%, because the chart has been consolidating under an extreme level of resistance for a while. And that energy was released today. Now, can we see a follow-up for the Dixie tomorrow? The answer is the Dixie will be highly sensitive to what? To the employment report. If it comes out too hot, my hunch is we will see another rally, another leg higher for the Dixie. On the other hand, if we have a softening, keyword softening, not a crash, a softening in the employment report, meaning the cooks are giving us a mild reading, we could see the Dixie moving down. And if that is the case, it will be good for stocks. But not only that, it will be good for commodities. namely gold. Look at gold reaching support at around 1,685. It is the ideal time for gold to catch a bounce. It is a critical level of support for the bulls to keep. We'll see what happens tomorrow, but the likelihood says dollar down, gold up, short covering in stocks. Again, I'm not a prophet, folks, but I'm just reading the tea leaves. What about Brent oil? 4 hours chart. What's going on here? The bulls lost 94.47. Not a good look here, but we have oversold conditions. And if the dollar moves down tomorrow, we could see dip buying in oil, and we could see a weekly closing above 94.47. The bulls have to close above 94.47 to keep the hope alive. Otherwise, down we go. Now, what about the 10-year yield? What's going on here? It is reaching somewhat of overbought conditions. It is at the resistance of around 3.28. It is the ideal time for the 10-year yield to pull back, depending on the employment report. If it does pull back, technology will do pretty good. We're talking about the big caps, software, chips, most importantly. But also the TLT, this is a weekly chart. Yes, the trend line is gone, but the support line of 109.5 is still here. We could see a double bottom formation and a pop higher. Again, folks, everybody talks about September being bad. Everybody's talking about it. Everybody and their mothers talking about September being bad. My hunch is the first week and a half might actually be good. And then mid to late September, the slaughter resumes. Here's the VIX 4 hours chart. What's going on here? We have negative momentum from a MACD perspective. The bull flag played out, but it stopped right at the resistance at around 27.5. The chart is saying right now, this is the technicals, of course. I don't know what's going to happen after the employment report is out, but the technicals for now say we have a triple top. We also have a triple bottom. We have a range, but the likelihood is the range will be broken to the downside. We will see the VIX visiting 24.29 as support, unless we have a massive surprise from the employment report. What about the big kahuna, Apple, a daily chart? What's going on here? It held on at the critical support of 157, and the chart closed the day above this number, this very important number. Why? Because the prospects of a reverse head and shoulder formation will not happen until Apple keeps 157 as support, 150 max. So this is a positive development, even though I'm short the name. You know my strategy. I sold the 150 puts, so I have the 160. I sold the 150 to raise cash. I have the October expiration, and I sold next week's expiration for the 150 to raise that cash. We'll see what happens, but for now, this is the strategy. Tesla. An hourly chart. What's going on here? The bear flag played out. We got a flush down in the morning, but then the dip buyers showed up right away, and the chart closed above the gap. Is this bullish or bearish? The answer is it is bullish. The chart got severely oversold in the RSI and it bounced higher. The likelihood is Tesla will close the week above 280 if we have a decent day tomorrow. And that keeps the bulls alive, at least for now. And lastly, what about tulips? Bitcoin, 4 hours chart. Now we have a triple bottom. And the chart is dancing back and forth at 20,000. If it wants to go down, it had plenty of time. It could still go down. I cannot guarantee anything here, folks, but the risk versus reward says we should see a pop before we go down. And lastly, moving on to the conclusion of this video, what do we have tomorrow? In case you were asleep throughout the video. The most important unemployment rate, the non-farm payrolls, which includes the unemployment rate and the average hourly earnings, aka wage inflation, all important data. And then we have factory orders, and besides that, that's all we have. And then we head to the long holiday weekend. So happy Labor Day in advance, but this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again over the weekend.
When the chips are down, these civilized people, they'll eat each other.